What's the difference between accounting profit and economic profit? Well, accounting profit is the difference between total revenue and an explicit cost. These are like wages or rent. Economic profit goes further. This will be subtracting off those implicit costs, and this is going to be the value of what you give up, like the income you could have earned elsewhere. You should think opportunity cost. In this video, we'll break down these concepts and see why economic profit gives a deeper view of business decisions. Economists take a somewhat different view of profits than what you might have learned in any sort of accounting class or how accountants view profits. All right, so in this video, we're going to make a distinction between what economics profits are and accounting profits. Accounting profit, these will be anything that are just like revenues minus your explicit costs. So revenues is what you get from selling your goods or services, the money you get in. And our explicit costs are anything that you have to actually write a check for to someone. Right? These explicit costs are direct expenses. Right? They're clearly defined costs. These are expenses you must pay. Examples of them would be the wages to your employees, the insurance you have to pay on your building, taxes to the government. If you're a restaurant, you have to pay for the raw materials, the food ingredients, your electricity bill. All these things, you're actually writing a check out for cash. So I'm going to go through an example of how to calculate an accounting profit. So say you wanted to start a fried chicken tenders restaurant in Oxford, which former Miami alums wanted to do. And they did that at Ox Vegas a couple years ago. So let's just assume that you're going to make $100,000 in revenue from this restaurant. You have to pay $70,000 to your workers, your rent on the building, rent the kitchen equipment, and the cost of the chicken. All right, so these are all your raw materials and labor and capital that you have to do there. And then you have to pay 30% tax on any of these profits that you have. So if we take this information and do a rundown of calculating that profit, we would take our revenue from the sales of those chicken tenders, the money they get in, minus that $70,000 for our explicit costs of workers, machines, ingredients, that sort of thing. And so then we're left with $30,000. These are called your pre-tax accounting profit. So you haven't paid taxes on this yet. And so now that you would pay 30% on this pre-tax accounting profit, and 30% is going to be $10,000. And so we're going to subtract off your taxes of $10,000. This is also an explicit cost. And so now you're left with $20,000 after all that. Right? This would be what your accounting profit is. Right? That $20,000 of your revenue minus all of your explicit costs. If you were a public company and you had to report your financials because you're on the stock market or something, you would report this accounting profit. Okay. Now, economic profit goes a little bit further. Right? Economic profits are revenues minus all costs, both explicit and implicit. So everything we subtracted off of our revenues before, for wages, chicken tender costs, all that stuff, that's still coming off on our calculation of economic profits, but they're also going to take off something additional. These are implicit costs. Implicit costs, you should think about these as opportunity costs. So what could the firm be doing instead? So what could they be doing instead of opening up Ox Vegas? Right? They could go get a job. They could open up a bar instead, right? And so that's like, what would they have gotten in terms of profits from doing the next best alternative, their opportunity cost? We want to subtract off this opportunity cost from our accounting profit, and that's going to give us our economic profit. Okay, so we're going to start with our accounting profit example here. So everything here is just the same. Notice that this doesn't include any implicit costs. We're only subtracting off these explicit costs. So we don't have the opportunity cost of the time that the owner spent building this company or working at it. We don't have the cost of like the investment, all the money they put in to starting Ox Vegas. They could have just invested in the stock market. We're not subtracting that off. Right? That would be the implicit cost. So the next best alternative, let's just assume that it would have been to open up a bar instead in Oxford, and they would have made $15,000 in accounting profit in that opportunity. They didn't do this, but if they would have chosen to do this, this would have been their accounting profit. Right? Because it's their next best alternative, we can call this the normal profit. Okay? All right. Normal economic profit, normal accounting profit. The opportunity cost of opening this chicken joint is going to be this implicit cost of $15,000. If they didn't open the chicken restaurant, they would have made $15,000. That's the implicit cost, that opportunity cost. We want to subtract that off. So on the next slide, same information. Now here we're down to this accounting profit that we had before of $20,000. Now we're going to subtract off that normal profit, which is your opportunity cost, the value of that next best alternative of $15,000. And now we're left with $5,000. And so this would be your economic profit here. It's less than your accounting profit because you have to subtract off that opportunity cost of what they could have done instead of opening that chicken restaurant. Okay, so economic profit is going to be your accounting profit minus those implicit costs. So it's going to be a little bit smaller. Okay, so in my example here, we have positive economic profits of $5,000. It's greater than zero, right? And so these would be extra normal profits. So this is great. You want these economic profits because these are like better than you can do in any other situation, any other activity, instead of opening up a chicken restaurant, right? So this is going to be good. Right? But we could have had different amounts of an opportunity cost, implicit cost to subtract off. So here I have that implicit cost $15,000 is less than your accounting profit, right? But it could be different, right? Let's suppose that the opportunity costs in the previous example were $30,000 instead of $15,000, right? Here we would have subtract off $30,000, and this would be negative, right? It'd be a negative $10,000, and that would be, we would call those economic losses, right? So we can have a situation where a firm is earning positive economic profits, but economic profits may be zero or even negative, right? Zero economic profits means your accounting profits are equal to your opportunity costs. So this would occur if the opportunity costs in the previous example were $20,000 instead of $15,000. So our accounting profit was 20, our next best alternative was also give us 20, and so our economic profit would be zero. Like that doesn't mean that you're doing a bad job. It doesn't mean that you should get out of this business. It just means that like you're making the normal profit, nothing above and what you'd expect over your next best alternative. Okay, but if you have negative economic profits, that means you and your inputs could do better elsewhere, and that means you should like switch businesses. Right? So if you're having negative economic profits, you could have made more economic profits in doing your next best alternative, something else, and you should go switch into that because then that would give you at least zero economic profits or even positive.